You've heard by now, inflation is out of control. And with the print on Friday, the markets gapped down and just kept falling and falling and falling. This has led into the futures market at this stage, and the only good hope for bulls out there is we're entering into a level where Wall Street has purchased before. Is this all part of a bigger fake out to pick it back up, or is this something more sinister on the horizon? Bond yields are showing us something worrying. So let's take a look at stocks, commodities, and of course cryptos that are falling to new lows as well right now. Stay tuned. This is going to be a good one. Well, welcome back everyone to the weekend show here. If you like stocks, commodities, or cryptos, of course, remember to subscribe and smash that like button if you find value in today's video. Straight away, fear and greed index, no surprises, 28, jumping back into that fear, extreme fear level. And of course, we have to expect that. But I want to discuss something here before we get into anything else in the market, and that is the bond market. Yield curve inversions matter. And as we've talked about this before, we've seen some big yield curves inverting over 2022. Guess what? They're about to do it again. So we'll look at that very, very soon. But I want to discuss 50% of all yield curves. If we ever see time in, you'll notice every single time we saw that much inversion of bonds, we ended up leading into a recession. So watch the numbers and I'll show you some of the key ones to be checking out today in this video. But we'll be watching this very, very closely moving forward. Near lows, or at least very close to lows. So we'll find out whether this occurs. But for 1% daily declines do often show a shakeout of the market. And I know we have massive negative news across the board. It's going to be hard to see the positive from any of these negatives, but let's let the price action and the actual order flow show us the way. And I'll show you how that can happen very, very soon. Don't panic in times like this. We have to be prepared for the next eventuation, and of course, whether we actually get through a new low or do find demand here again from the street. Let's talk about the VIX. The fear index, of course, spiked through the Friday session. There's no doubt that inflation peak was really bad and it pushed bond yields insanely. Like they were moving heavy, heavy, heavy. We saw the 2-year go 3.153. It actually went even higher at one point. And we saw the 10-year basically just joining it with that. So now we have, at the time of this recording, a 3.153 2-year and a 10-year yield at 3.176. This is a big deal. For anyone that doesn't know, inversions matter, and the bond market is generally more in front in terms of actually understanding whether the market is about to go into a recession. From your brief understanding of bonds, let's just do a quick rundown straight away. The US 2-year and 3-month are generally controlled by the Fed in some way. The US 10-year, that is the US 10Y, is generally controlled by the market. That is, it's so far off, the market tells you what's going on. If we're going into a recession, what will happen is the short rate will usually go up above the long rate. And whenever that happens, we get inversion. When inversion occurs, the market is effectively telling you, yes, okay, good work, Fed. You've raised the rates, you've got them higher. But at the same time, what's that really telling us? That sometime in the future, the market knows that rates are going to have to be cut again because of a slowdown in the economy, most likely recession. It's a very good indicator. We saw it before in the charts. So we've got another yield inversion coming. Now, these are not good at all. You've seen them here back in 2019 into 2020. Whether we went into a pandemic or not, we were going to most likely have a big pullback and crash in 2020. It's just the nature of these types of events. And as you can see here, my favorite old school one, which was the 2-year versus 10-year, has shown you inversions in the past, and they have often led into epic declines in the market. Once the Fed starts this, of course, it's very difficult for them to stop the rate hikes. Another one that's going off here is US 2-year versus 5-year. That's getting very close to inverting again. Again, similar back in 19, it inverted. We end up going into, of course, a crash and a recession at that point. We've got 5-year here versus 10-year. Again, that is actually inverted at this point, not a good sign. And if we go back to all of those times when we have so many bond yields inverting, it's really a bad signal. So we'll continue to update you on this, but just remember the market hates the 3-month and the 2-year going up. It's not really a great thing here for markets. And if you actually ever bring them over the top of each other and load SPX here, you'll notice that when it started spiking, it usually kind of coincides with the area of weakness or at least slowdown in the market. The only way the market can go back up when you've got yields rising is usually real earnings. That is, the companies underneath are actually growing at a big rate. Is that happening right now? I'll let you guys answer that in the comments down below. Let me know what you think. Let's move over here to the dollar index. What's going on with the US dollar? Well, it is bullying out of control. It went past the 103. You can see it had a little bit of a fight zone with that. And we're back into this area again for the US dollar. So it's now or never for the US dollar bears to really get back on this. And this is why the synergy with the market is so important, because we've gone back into a supply zone. Effectively, when the market came through here, it crashed back down, which we were on. And we're obviously talking about this a lot back when we were at these supports, these demand areas for the stock market. But now we've gone back up. So if the US dollar is going to turn, it needs to turn in this box area here. And what you're looking for is a structural turn. So you're basically looking for something like this, and then a structural break of that down, effectively faking out to the upside and then pulling straight back down from that. We'll look at that a little bit later on. The only thing that's been relatively safe has actually been gold, something that we've talked about very strongly here on the channel with you guys. A lot of you post in the comments that you were bullish gold, and guess what? It's held the best in this market against so many other things that haven't held well. So gold came back to the 1830 defended zone. It swept the orders around this point and then bulled straight back up again. And this is a good sign for gold holders. Of course, that was a pretty decent switch here. And I'll go to the 1 minute just so everybody can see what happened here. It was a pretty big turnaround story. Effectively, what happened is gold actually turned bullish around here. It made a new low, swept those orders underneath 1830, the stop losses that were there. Nasty market. It's what it likes to do, unfortunately. The algorithms got involved there. It bulls up, comes back, gets the other orders, and it's on to the races. So gold's been a good one. I would continue to think that gold should do okay in this current environment, but again, it needs to make a new high, and then of course the continuation there would be somewhere upwards of that 1918, 1920 level. Let's now talk about XLY, XLP. This shows us risk on and risk off for the markets. So in general, risk on actually is holding better than you would think. I mean, you look at the market and you'd say, oh, it's horrible. And in some ways it is, but it actually, compared to staples, it's held up a little bit better. We're still on a point of pretty significant rotation. We'll find out what happens after the Monday session. We'll come back and revisit this, but I just want to show you here, it's not as brutal as it was last time it came down. The market itself looks brutal, but the actual risk on risk off sentiment, it looks like there's a little bit of rotation still going on there in the market. Let's move to the Dow. Of course, the Dow really getting a clobbering here. Big companies taking the brunt of the hit, and they're almost down to new lows. Big 3 days of sell-off, of course, the fourth day up here. And at this stage, at the time of recording, we're in the demand, or we're in that kind of supportish zone for the Dow. If it's now or never really for the bulls to come back in this market. IWM is similar, but this is where things get interesting. Look at IWM in comparison. Even if I load up the futures market, you'll notice it's holding a bit better than the Dow. So the Dow is almost back down new lows. IWM is not quite there. It's back around this area, around that previous buys that you had in the 20th of May and also the 24th of May. So is this telling us that there's rotation still in these markets? Be careful, but of course, you don't want to predict things here. You want to actually react to the market finding base. But at this stage, it's interesting to see the smaller caps holding a little bit better than the big caps. And that's something that's different in this market as it drops through here. Now, talking about NASDAQ and what's not faring so well, the NASDAQ at the time of recording closed a monstrous, or opened a big gap. So we have a huge gap here, which will most likely need to be filled in the future. Notice in this chart, of course, the Wyckoff ended up confirming and just has created this massive flush here in the system. There's the Max Payne kind of UT. We spoke about it a little bit, but more importantly, once it got through this defended zone as we spoke about it, it just got crushed. I mean, the market just went falling and falling and falling. To get a pickup from this type of market, you must be careful and you must really have good reaction and not necessarily prediction. And what I mean by that is the market will probably, it could go, who knows, it could go 11.2, it could go 10.8, it could go 10.4 and just keep falling. If you're a bear, what are you looking at here? You're saying, okay, I can see that there's buyers that have come in here previously. We're not through that yet. You might believe that you're going lower, but at this point is a danger point. This is where it could easily flip and you could see even a low, and then all of a sudden something like this sequence, and then bang, straight back up. I know the news is super negative, and we'll talk about that in just a moment, but this is the type of zone or area that you do need to be careful in these